Welcome back to the Brent Bruce Daily for February the 6th, 2023. It is now 2:37 p.m. Central Time, and unfortunately, over the weekend, the global markets have been digesting the employment number that we received on Friday from the Bureau of Labor Statistics, and they have not been liking the numbers. As you recall from Friday, we had a blockbuster number, a blowout number from the Bureau of Labor Statistics when it comes to employment, showing tremendous job gains and very low unemployment. Not what we really agree with. Unfortunately, the other reports that we're receiving do not show the same indications. The ADP report, which surveys 25 million people in the United States, was not even close to those figures. As a matter of fact, the BLS numbers were, I believe, 4 times higher than the ADP numbers. So this doesn't seem to make sense, and everyone was shocked. Unfortunately, throughout the weekend, there was shock waves throughout the globe, which rolled over to the Bank of England, the European Central Bank, and basically have started to create comments from them or a feeling from them that they need to be more aggressive and hawkish when it comes to their monetary policy because they feel that, unfortunately, inflation is still too hot in the United States, which, as you know, is not good for mortgage-backed securities, not good for the Treasury market, and not good for interest rates. So let's take a look and see where we are right now. Let's go over to our chart. Unfortunately, again, we're down 50 basis points today, based on not only the report from Friday rolling over to today, but also the comments and the, not necessarily moves, but the comments from other global economies and what they're saying about that report. Where 10-year Treasury is now up 11 basis points, also not what we want to see. You can see here on Friday, we were battling previously with the 200-day moving average on Wednesday and Thursday, but Friday came in here and really pushed us down below this Fibonacci level, the 25-day to 50-day, and we opened the market today. So we opened below both of those because of the movements throughout the weekend. Now, you've heard me say before that banks like to hedge their bets because they don't know what's going to happen over the weekends, where sometimes they will push up their interest rates maybe about 0.1%, just in case something strange happens over the weekend when the bond markets are closed and they can't make hedge moves. Well, that's kind of what you're seeing here, is that over the weekend, things got worse in the bond market. We are now down here in this range, and now, crossing our fingers that the Fibonacci level here, which is at 100.758, holds, and we don't continue to fall until the markets regain their senses, look further into this report from the BLS, and realizes that there is just something that doesn't smell right. Then we're going to have to climb all the way through and battle with our 50, our 25-day, and our Fibonacci level again before we can start to have that battle with the 200-day moving average, which is what we really want to see. So let's take a look and see where we're at on our home loan interest rates right now. Currently sitting at, let's go ahead and run this, our Brent Bruce Daily 30-year fixed conventional, very well qualified customer. 6.375% with a small credit of $479. Now, again, this is 0.5%. In 2 business days, we are 0.5% higher in interest rate than we were because of one report. And that goes to show how volatile the markets are, especially the home loan interest rate market is, and how these reports really matter and why these things happen. Hopefully, you're beginning to really pick up on these moves. What if we want to pay a point? Where would we be? Okay, so for about exactly 1 point, we would be at 5.875%. 5.99 is only costing 0.68, so a little bit more than 0.5 point to get there. But unfortunately, this is a pretty big move from where we were even on Thursday. Let's take a look and see what our parameters look like for compliance purposes. There you go. All right, so what is next? So first of all, this week, there's not a lot of reports coming out. There are bond auctions, though. And unfortunately, I think those are going to hurt us because now the bond market is concerned because of this report that came out on Friday and now the comments that are being made from other central bankers around the globe. Not a good recipe for the rest of this week. But we do have that Fibonacci level under us, and I believe that people are going to start to call a bluff on some of these reports coming out from ADP and start to see a little bit further into the way they're calculating their data and how that has changed recently, which is probably the reason for such a dramatic, surprising move. So hopefully they'll be able to look into that further and figure those things out. Otherwise, we are going to continue to battle to crawl back up above those now ceilings of resistance and hopefully get back into the 5.875, 5.75, 5.5% range here later in the month. We'll talk to you again soon. Let me know your thoughts. Make sure that you like, subscribe, and share. We'll talk to you tomorrow.